I mentioned kind of this dazed and confused feeling that the market has, and that the notes are conflicting. Strategists are conflicted. JP Morgan says it's almost the time to add back risk into your portfolio. After UBS yesterday said go underweight global equities, there's just too much uncertainty politically and otherwise. So I leave it to you guys. What should you do?
Well, you know, it's interesting. So I understand kind of your perspective. Unfortunately, though, there are investors that have to remain invested. So they don't have the ability to pull all their money out. So they have to find value in the marketplace. And what's really interesting right now, at least at Loop Capital on our desk, I called my equity desk this morning. I said, guys, what are our clients doing? We cover a lot of large institutional investors on our desk. And I said, what are folks doing? Interestingly enough, they're doing, Scott, exactly what you said. They're actually buying on some of these dips. Almost 4-to-1, we're seeing buys in consumer discretionaries. We're seeing buys in financials, in technology. So, you know, we're seeing people picking up in areas where their portfolios have space, have room, and where they've seen a little bit of a downtick, that they're now able to pick up some of the names that they like to want to hold for the long term. And I think that's where investors have to be right now if you're fully invested. So I don't care if you're running a strictly equity portfolio, if you're running a fixed income portfolio, you have to play right now. And so the question is, what are you buying? And when you talk about global yields and you talk about what's going on the global stage, the U.S. is the best game in town right now if you're on a hunt for yield. And so whether you like what the CEO, aka Mr. Donald Trump, is doing here or not, when you talk about the flight to quality and buying gold, you have to then say, okay, from a country perspective, where is that flight to quality? It's the United States.
Lows of the day for stocks. Yes. And I wonder, Joe, what the message of the market is, so to speak. Our friend Larry McDonald had an interesting tweet earlier in looking at the groups of stocks, whether it's sectors and their performance on the S&P 500, and cites over the last 12 months that staples have outperformed almost everything, and quite dramatically, up 15%. The XLP staples have over the last 12 months. Discretionary is up 3%. The S&P is basically flat. Financials, we know, are disappointing. The Russell's disappointing. The banks are disappointing. And the message in that is that they outperform ahead of a recession, that consumer optimism peaks ahead of a recession. Confidence number today was exceptionally strong. So we're at the crossroads, it feels like, of what's going on.
Well, we're at a stall, and we're at a stall because I keep talking about it. I think the communication from Washington, D.C. has been wrong since Thursday, August 1st. 28% in the S&P, that's the gain from the day that the president was elected until he announced the steel and aluminum tariffs of March of 2018. We're up somewhere around 3 or 4% since then, so somewhat sideways. The high beta equity exposure type names respond to a correlation. The correlation previously was, where's the Chinese currency? If it was valued above 7, equities move lower. That correlation now is specific to the 3-month to the 10-year, which is now negative 50 basis points, and the 2-year to the 10-year, which is negative 4.5 basis points. When we begin to see that correlation break down, then the opportunity will be there for equities to resume the uptrend once again. I disagree with the premise that a recession is looming. A recession is not looming when you're looking at other asset classes like REITs, like investment grade, like high yield, like municipal bonds. There is internally in the U.S. economy an untold story where it feels recessionary, and that's what's going on in the steel industry. And we're not spending enough time talking about what's going on in the steel industry because the automotive industry, the oil and gas industry, because of the tariffs and the rising production cost, they have basically taken demand off the table for these steel companies. And you've got a U.S. Steel that now has a market cap of $1.5 billion.
Oh, that stock's gotten obliterated over the last year. Goldman says there's going to be a bigger GDP hit from the trade war than people are expecting. They say 0.75 of a point. And that's a lot bigger than a lot of other folks had forecast.
It is. And then you look across.
Therein lies the concern about why rates may be moving and, stagnating where they are, if not moving lower, why some of the other concerns are out there about earnings taking a bigger hit than people are expecting, and thus the stock market can't get out of its own way.
Scott, yesterday you said, John, you're one of the shortest term traders in terms of time frame for buys and sells. That's very true. And I still am today, which is short term. But when you're looking at the market right here, and I was listening to Tony Dwyer this morning talking about when you see the signs of a recession, it's usually corporate credit just gets crushed, obliterated, gets pushed off. People don't want it. You're not seeing that.
Spreads are tight. Exactly.
I'm saying right now that I'm buying on these 5% dips like we just got. Facebook last week, you got a chance to buy it below 177. Today it was, when the market was higher, it was over 184. Right now it's 183. I think there are lots of scalps like that you can put into the market almost any time here. So I'd say concentrate on what the market is giving you. When it gave you that flush in Apple, a week ago as well, I think you buy on into that. And to Larry McDonald's quote, and I love Larry, love you, Larry, XLK is up 26%. He says Staples up 15, and he is correct, of course. But you look at the XLK, broad market technology, that is up 26% versus 14 or 15, whether we're talking about S&P 500 or Staples. I'll take tech every day of the week.